Well, stocks slipped, bonds gained, and the dollar slumped last week as Fed Chair Powell said that they're not far from having the confidence required to deliver the first rate cut, and as the ECB kicked the can down the road to June as the next live policy meeting for the folk over in Frankfurt. And of course, after what was arguably a disappointing US jobs report, despite another blowout headline non-farm payrolls number. This week, focus turns to inflation with the US CPI figures due on Tuesday, but it's a busy data docket on this side of the Atlantic as well, with jobs and GDP due from the UK, as volatility shows some tentative signs of awakening across the board in financial markets. We have plenty to discuss on the trade-off this week. So without further ado, let's get into the show. So it was a very busy week for the financial markets last week. Plenty of events to digest and also a little bit of volatility starting to come back as well, particularly in the FX space. And a busy week awaits this week with, of course, those US CPI numbers in focus ahead of what is going to be an even busier week the week after, when we have, among a whole host of other things, 6 G10 central bank decisions in the mix. And of course, one of those could possibly be the BOJ's first rate hike since all the way back in 2007. Joining me as always to try and make sense of everything that's going on at the moment is my good friend Ryan Littlestone from Forex Live and Forex Analytics. Ryan, a very good afternoon to you. It is a little bit grey outside today. I was down by the Bank of England earlier and it certainly didn't look like it does in the background there.
No, it's always grey down where you are, isn't it? Especially around the Bank of England. But yeah, fortunately, the weather's been holding off down here, so not too bad. I actually saw the sun this morning, so that brightened my day.
Blimey, that is a collector's item, almost as much of a collector's item as volatility has become in the G10 FX space. But signs that the market was sputtering into life a little bit last week, wasn't there, with the dollar having its, I think, its worst week of the year thus far.
Yeah, very much so. And it was a big week, events coming left, right and centre. And my question was, our market's going to move to new areas? Are we going to break some of these well-worn ranges we've been walking in? And in fact, we have. So there's going to be lots to talk about today.
Absolutely, and we'll get into those charts in a second. But before we do, we've got to get into Topical Thunder and discuss some of those narratives and themes in a little bit more detail. I think that might be the slickest intro to the show that we've ever done. It can only go downhill from here, mate, can't it? Let's be honest. Right, I want to start this week with a look at some of the US data that we've had over the last week, and also a look ahead to what we've got coming up this week. Of course, we had that non-farm payrolls print out on Friday and the labour market report more broadly. And at first glance, you would say, actually, it was a very, very strong report if you looked only at the headline payrolls print, with jobs rising by employment rising 275,000 on the month, around 75,000 above the consensus estimate. But in my mind, that is just about where the positives end in terms of that jobs report. Unemployment rose to 3.9 from 3.7% prior. That's a 2-year high on headline unemployment. Participation remains subdued at 62.5%, staying where it was after falling off a cliff pretty much in the weather-affected January. Average hourly earnings growth cooled to 0.1% on a monthly basis. That's down from the whopping 0.6% that we saw in January, although a big chunk of that cooling is actually due to average work week hours rising. They are effectively two sides of the same coin. So if you see work week hours rise, you generally see average hourly earnings growth cool a little bit. So maybe should take that one with a little bit of a pinch of salt. But perhaps the biggest stat out of all of that and the biggest disappointment was that those blowout numbers that we saw in December and January were almost entirely revised away, with the 2-month net payrolls revision down 167,000, which is the biggest downward net revision since April of 2022. Now, I'm going to do something a little bit different here because I want to talk about inflation in a second, but Ryan has teed me up earlier on to tell me that you want to take issue with me characterizing this as a disappointing jobs report. So take it away, mate.
Yeah, context is needed with this. Any other time that would have been a decent jobs report, even if unemployment missed expectations and rose, even if unemployment rose where the participation rate stayed unchanged, which did make it a negative move. Unemployment 3.9%. Who's going to worry about that? The Fed aren't going to worry about that. If we'd seen unemployment moving to 4.2, 4.5%, then maybe a few people could throw some toys out the pram. we still got a strong headline number, well above the 200s. Even the revision from last month still in the 200s. There is no stopping this jobs market at the moment, and people scratching around for a couple of pips here and there on each of the numbers. When it's a trend, come and see me. Until then, the market wants to get bearish the dollar. It's been wanting to hit dollar rallies. We said it last week that this market is just a dollar rally hitting machine at the moment. And any item of data that it gets to enforce that view, it's going to take it. And that's where we are at the moment. But is it a bad jobs report in the over the last 2 years? No, it's not. It's still well within soft landing themes, and that's what the Fed's going to look at mainly.
I would very much agree with that. I think it does still signal a soft landing. I think the concern people have got is it the start of a trend? Of course, everyone is trying to front run that trend. It's no use if you're trading short term at the very least, if in 3 months' time going, oh, actually, it was a trend that unemployment was, and we're now at 4.3%, then you're obviously going to naturally try and get in front of that. But I do see what you're saying, and maybe I'm being a little bit too pessimistic and cynical over here. It certainly wouldn't be the first time. But of course, this week...
Not the last.
Most definitely not the last. Not the last in the next sort of half hour of this show either, to be honest. But of course, this week, all eyes now move on to CPI. We're expecting headline inflation to remain unchanged at 3.1% on an annual basis, to tick up to 0.4% on a month-on-month basis. On the core number, though, stripping out food and energy prices, modest downtick to 3.7 from 3.9% is seen on the annual rate, and month-on-month set to cool to 0.3% from 4 prior. There's still a lot of skew coming in here from shelter. The BLS seem to be having awful issues trying to calculate something that they call owner's equivalent rent. Good luck Googling that if you really want to. I went into the weeds on that calculation yesterday and thought at one point I wasn't going to emerge. But I think the key thing here is that we come into the CPI print with the market pretty much where it was last week in terms of Fed pricing. First cut still seen in June, about 90 basis points of easing priced over the remainder of the year. Do you think that's still reasonable, Ryan? Do you think there's decent scope for that to move in either direction on the inflation number?
Yeah, I think there is. Even at 93 pips, it's still above where the Fed's sitting. So, yeah, there is still some discrepancy there. There's potentially a lot of noise in this CPI data. As you said, there's all that housing, shelter, rent stuff that supposedly affected the numbers last month. Everyone in the PCE was pointing at the super core and everything like that. So, again, people are going to pick out the numbers they view. The market's going to move on wherever the number does. If the number's higher, it's sticky. If it's lower, it leads to Fed cuts. So that's the easiest way for us traders to look at it. But just going back, you're right about the market getting in front of the trends. We've been talking about the US consumer. Are there wobbles coming in for those? And we get retail sales this week as well. So that'll be another little clue. So I agree, getting in front of it, but we've tried to get in front of these jobs numbers before and ended up with egg on our faces. So, we've got to be careful with it.
Yes, very much so. And I think the US economy is a juggernaut that you probably wouldn't want to be getting in front of at the moment. Never bet against the US consumer, as the saying goes. I think never bet against the US economy, if we want to broaden that out, particularly given that the consumer basically is the economy at this moment in time. Anyway, we'll talk about rate cuts there, when the Fed are going to start. I'm going to talk about the summer of cuts in a second, but there is one central bank out there that is not going to be cutting rates, and it looks like they may finally, at long last, be putting us out of our misery and delivering that much anticipated first rate hike over in Japan.
Yeah, very much so. We spoke last week about the market's attention on the Bank of Japan last week, and that really stepped up a few gears after we recorded the show. We've had further sources pieces touting that they'll change the monetary policy framework, looking at YCC as a policy in itself, and as well as that, the bank apparently leaning towards now a March hike, which brings things a little bit sooner than we expected. Now, we had BOJ's member Nakagawa sort of changing her tune last week from wanting to continue easing to saying that they are making this steady progress towards inflation goal, and that she had 10 days to look at the upcoming data before deciding about ending easing. Now, on the wages front, we've had one of the large unions, industrial unions, UA Zenzen. They've announced wage hikes of 6.7% and 5.15% for base pay, which is far bigger than they had in 2023. This week on Wednesday is a big day. We get Toyota set to meet the unions, finally getting down and talking about those wage demand numbers that they put off for a couple of weeks. Then on Friday, we've got Rengo out with their first, their first tally, if you like, of the first round wage negotiations. They said last week that the demand so far coming in around 5.85%, which is well above the 4.49% that was demanded last year. This is the first time these demands have been above 5% since 1994. So it just shows you the scale of wages over there, how low they've been. So they're releasing these results. Nearly. I'll check my badge again, but no, I think it was on its way out in those days. But yeah, definitely more than I have now. Yeah, so we get those first round talks from Rengo, and that's going to be a huge deal for Japan because it's pretty much going to seal the deal for ticking the box on wages for the Bank of Japan and the government. We've also got Kishida having some trilateral meetings with business lobbies and various other parts of his government and businesses, again, to try and enforce this wage hike move that they want over there. Now, if the numbers are agreed this early, particularly with Rengo, it's going to seal the deal for March, in my opinion, and in the market size probably. As such, it's really going to be another big week for the yen, which is being reflected in the vols at the moment. We're seeing those 1 month vols in dollar yen risen from 7.7% a couple of weeks ago. They're now sort of 9.2, 9.3%. So if you trade the yen, strap in tight this week. It's going to be very busy. And I want to repeat my question to you, Michael, from last week. No, it's not. Are you going to be sending a letter to Westy on the back of these wage demands asking for a bit more money? It's going to be about, we had the question, March or April. What do you think now since we've had all this news?
Oh, I mean, I would be incredibly surprised if it's not March at this point. I mean, you obviously track the Bank of Japan much more closely than I do. But, it just seems like all the little jigsaw pieces are aligning for this to be a move in March now. And I think the important thing you've got to remember, particularly in terms of those sources stories you mentioned, Reuters ran some stuff, GG ran some stuff. I think Bloomberg had some stories out at one point as well. That's not an accident. That's not a coincidence. That it feels like a coordinated change and a coordinated message that policymakers within the Bank of Japan are trying to put out to move the market in the direction of, yes, we are going to do this, and yes, we are going to do this in March. I think the OAS curve in Japan is pricing about a 75-80% chance that they do move at the March meeting. I don't think it's going to price any more of a probability than that, just on the risk that we do get disappointed once again. I don't think there's going to be that's going to move all the way up to 100%. But yeah, I would be very surprised if we didn't get a March hike now. Obviously 10 basis points, that's all it will be. And it's the first BOJ meeting in forever that I might actually get up out of bed for, to be quite honest with you. I'm actually feeling a little bit excited for the early hours of next Tuesday morning now.
Yeah, well,
please don't get the wrong idea from that comment on its own.
Yeah, well, I'll probably see you about then because I think everyone's going to be up for that one. And yeah, the only thing I would say just finally on this March call, I don't think it matters right now whether it's March or April. If they don't actually do something in March, they'll be teeing up April anyway. So I think if they do go in March, it gets everything out of the way and then we can all move on. So in terms of market impact, all we're looking for really is that confirmation move, the confirmation from the bank that they're doing something, be it March or April. Then we'll see what the yen wants to do with it and yields and every other asset as well. So, yep, it's going to be a big one, but that's for next week.
Indeed, yes, I'm sure we'll get our teeth into that much more next week. And of course, the other question is, what do they do next? Is it one and done and then they go and put their feet up, or do they deliver a couple more this year? But we can get into all of that this time next week. We do need to move on, and what we need to move on to is pretty much every other G10 central bank, because it wasn't just a busy week in terms of Japanese monetary policy last week. It was a busy week pretty much everywhere, although mercifully we were firstly spared any remarks from the folk down at the Bank of England, which I think we should all be thankful for. And secondly is that this week we are now in the Fed's pre-meeting blackout blackout period, so we won't be hearing any pearls of wisdom from folk on the FOMC either. In case anyone's interested, I might start a petition to have the blackout period for maybe 365 days a year. I'm sure plenty of market participants would be happy to sign up to that one. In any case, there is a serious message in all of this. I'm not just sat here to mess around. And that is that all G10 central banks outside of Japan, as we've just covered at length, are continuing to pretty much just sing from the same hymn sheet, in that rate cuts are coming, inflation is on its way lower, but that they don't yet have the confidence or enough data to formally declare that inflation is dead, that this disinflation we're seeing is durable, and actually the comfort to deliver that first rate cut. And Fed Chair Powell summed this up well last week in his congressional testimony, saying that, I quote here, that they're not far from having the confidence needed to cut rates. If the economy evolves as they expect, and they can begin cuts this year. That is a sort of very implicit nod towards June in my mind. ECB President Lagarde went a little bit of a step further and gave an explicit nod to June, saying, and I quote here, "We will know a lot more in April, a little more in April, and a lot more in June. A little more in April and a lot more in June." It's not really too difficult to read between the lines of what she's saying there, even if I did manage to butcher the quote the first time. But of course, the other thing with the ECB is that their staff macroeconomic projections now see inflation back at 2% next year for the first time this hiking cycle. Again, giving policymakers the green light to fire the starting gun on that easing cycle. And the message was mirrored over in Canada, rates unchanged at 5% as expected. Macklem not really hinting too explicitly at the idea of cuts, but saying it's too early to consider lowering rates, maintaining that data-dependent stance. And I think this just comes back to an idea that we discussed a little while ago on the show, and actually it's that what we're coming into is a summer of easing, or a summer of rate cuts, where policy rates will move lower, policy itself will move to a less restrictive stance as rates come down, and also as quantitative tightening programs come to an end. The policy backdrop should become more supportive and remain a positive and a tailwind for risk, and help provide some more upside in the equity space. But, and I think we saw the start of this last week, Ryan, the divergences that we're likely to see in terms of the magnitude of easing, when these easing cycles start. I mean, the BOE, for instance, the first cut is priced for August. The Fed, the ECB, we're still back in June. It's those divergences that might finally start to breathe a little bit of life into the FX market. And with cable breaking to the upside of its recent range last week, we'll get onto that in a second, I'm sure, it may just be the start of this summer of easing, not just subduing equity vol, but bringing a bit of vol back into the G10 FX market at long last.
Yeah, I agree with that 100%. And we did see it. I think, firstly, the ECB, they've been very specific now in June. You know, I hate the day after the ECB meeting when the floodgates get open and literally every single one of them is out by 9 o'clock in the morning giving their chapter and verse on it. But, you know, we had some of the doves obviously keeping April. They want to keep April as a live date. The rest of them, even some of the big hawks like Holtzman, you know, turning and saying we're in preparation mode for cuts. Others, Casimir putting a June date on, lots of others putting a June date on. It's pretty much now, it seems a slam dunk that June is going to be the date where they do their first cut. And that's a bit dangerous in my opinion, because here we go again with the ECB, always far more dovish than they are ever hawkish. And now they're pumping June. They're making it pretty clear that's when they're going to go. They need the data to conform to that view now. If it doesn't, it's going to put them in a bit of a spot. Let's say we get the next month or two inflation rising instead of coming down again. You know, we get that bumpiness that we're seeing in the US. Then they're going to have a job to try and push a cut at that point, because inflation won't be there. And, you know, they can spin it how they like. But I'm just wondering if the ECB are getting a bit too complacent, putting an actual date on this rather than, you know, June, July, or keeping it to the summer. You know, much like the Fed and the Bank of Canada have. They haven't put specific dates on. They've got work to do. They've made progress. They want to see more confidence. Yes, Powell's line that they feel they may be closer to confidence may indicate that one's coming, but he's not gone as far as the ECB. I think that's a smart move, because really none of them know what inflation is going to do over the next couple of months, let alone the next 3 years, as per their forecast. So, yeah, I'm beginning to think maybe the ECB again is painting themselves into a bit of a corner.
Yeah, it certainly wouldn't be the first time they've done that. And I think it's interesting because I'm sure we had this discussion last week where we sat here and when, they are data dependent, not guided by the calendar, and they will probably say that again. And then Lagarde has somehow managed to stand up at a press conference and go, we're not data dependent, but we're going to cut in June. Is the long and the short of the message that she's given us. And I think you're right. It is going to be pretty difficult for policymakers to push back on that. And maybe one of what has become a litany of things that the ECB have lived to regret saying since their inception back at the turn of the millennium. But not the first time they've done it, and probably won't be the last either. But why don't we move on and get our teeth into the UK a little bit?
Yep. Now I know Michael's probably going to have a big sigh about this one because we're talking about.
I haven't actually seen the. All I saw was UK. I didn't know it was political.
Oh, see, you're not doing your homework. Now you can have your big sigh. I knew it was going to be coming, but here it is anyway. But yeah, I'm just going to drop this one in here because it's potentially important for the pound. Last week we obviously had the budget, and that was probably more important for what it means for calling the election than it did for finding out whether beer prices were going up or not. So aside from lots of election-led sweeteners being thrown around by the Chancellor, the reception to the budget by the public may have caused Sunak to announce a date sooner than he previously suggested. His prior call was that his working assumption, in quotes, was that it would come in the second half of the year. However, late last week, he seemed unable to confirm that in typical political speak of not answering a question in an interview, whether that assumption was still valid. And that led to speculation that maybe he may be thinking about calling a May election, so one that's sooner rather than later. Now, what might help Sunak's decision making this week is the GDP data that we're going to be getting on Wednesday. That's going to be the first of the year, so the first January numbers. And following the UK falling into this technical recession in Q4, this January data will show whether the UK is going to start bouncing back or not. And Sunak will want to seize on any good news he gets to try and sell his party's worth in the election. Now, personally, we're expecting a growth print of 0.1% or something. I don't think it matters if we get a growth print of 10%. Nothing is really going to save his party right now. But it's important to know that every UK data point is a potential political campaign football at the moment. So as I say, for this data, we're expecting the monthly number to come in, as I say, a whopping 0.2%, just looking back.
Where's that bottle of champagne that I brought with me?
And that's firstly, the minus 0.1% we saw in December. The 3-month rolling number is expected in at minus 0.1%. That's obviously versus the Q4 number of minus 0.3%. So on the rolling numbers, it's a little bit better. But 0.2%, it would be welcomed by Sunak. Let's not make any bones about it. This is an election year. If we get an early call in the election, that might be a bit of support for the pound because at least we'll finally know what's going to happen nice and early rather than this dragging out into the latter part of the year. So UK data is going to be important, not just for the economy, but what happens with this election calling.
Yes, I think that's very true. I think not only data, but also monetary policy. You can just see that the BOE is going to become increasingly politicized as the year goes on. Politicians do a bad enough job of what they're meant to be doing, let alone trying to have a go at running monetary policy as well. But the longer that time goes on with bank rate remaining unchanged, and the closer we do get to that election, the more and more politicians are going to be implicitly and explicitly calling for the BOE to deliver rate cuts. And you would hope that policymakers on the MPC are strong enough to withstand that pressure and do what is right from a macro point of view rather than what is a vote winner. What I would say in terms of election timing, I think a spring election would just be mental, without putting too fine a point on it. I mean, you don't call an election when you're 25 points behind in the polls unless you want to lose. So I think they will. My working assumption is they will still probably wait as long as they can. I think in an ideal world, politically, you would want to, just putting yourself in the mind of a political strategist, you'd probably want 1 or 2 rate cuts to have been delivered. You'd probably want inflation much nearer 2 than 4%, where it is at the moment. And you'd probably want a lot more than just one semi-decent month of GDP growth in order to sort of kill those technical recession worries that are sort of pervasive at the moment. So I reckon October, November is still the timing, which of course means we'll probably get a UK and US election within about 2 weeks of each other. So stock up on your caffeine supplies now, because we're going to need them come autumn, I think.
Yeah, exactly. I'm not looking forward to that one. But yeah, I know you're going to talk about the pound in a moment, so I won't say too much on that front regarding the rate cuts. But I think, as we know, the Bank of England are going to be probably a long way behind the rest of them in terms of cutting rates. But yeah, we'll leave that for the moment.
Yes, indeed. We could spend, the next hour talking about that, but we shan't, because we need to get into some charts. Right. I am going to talk about the pound. I'm going to talk about gold first, because this is one that we spoke about last week, how the yellow metal has been benefiting from real yields coming lower, particularly at the front end of the curve, although a decent chunk of that has been driven by rising inflation break-evens rather than necessarily a move in nominal yields, although we have seen nominal treasuries rally as well. And of course, gold also benefiting from the dollar continuing to roll over. Of course, as we said earlier on, the dollar index having its worst week of the year so far, and the yellow metal has continued to shine as a result of those two positive factors. Gold adding almost 5% on the week last week. That's its best week since last October. And the yellow metal also rising to fresh all-time highs in the spot market, just shy of $2,200 an ounce, with futures also hitting new all-time highs as well. I am, though, beginning to question whether the move might have run a little bit too far at this point. As you can see on what some may call a chart crime here, but I hope I can get away with this chart nonetheless. If you compare gold to those two key drivers that I just mentioned, namely 2-year real yields and the dollar, you would very crudely say that the market has gone a little bit too far, a little bit too fast, which does perhaps raise the risks of a pullback. Now, of course, momentum is very much with the bulls at this point, so it's not something where you look at this chart and immediately go short the yellow metal. I think you would perhaps want to see a period of consolidation near these recent highs before then looking to enter a position, but it is something that is, of course, worth keeping on the radar, even if the move is pretty difficult to fade at the moment. The big risk here in the short term is obviously the inflation figures out of the US on Tuesday afternoon. If we get a cooler than expected CPI number, then you would expect to see yields move lower still. But I think if CPI does pass without event, if we are broadly in line with market expectations, then that could be the trigger for some gold bulls to take a little bit of profit, for the market to retrace just a little bit. And I think, of course, you've then got to start thinking about the March FOMC meeting, where there is actually a decent chance, I think, that we do see some hawkish revision to those dots, either because it will only take two policymakers moving their dot higher for the median expectation to move from 75 to 50 bips of cuts this year, or because there is some chatter, Loretta Mester from the Cleveland Fed raised this last week, that actually estimates of the long run Fed funds rate may be moved higher as well. So plenty of risks out there, and I'm just starting to think maybe the yellow metal has overshot just a touch.
Yeah, it's always a difficult one when you hit any market, it's an all-time high where we haven't got prior price action to rely on, no history behind it. It's difficult to know where the top's going to be. You get a lot of traders coming in, big move up, they want to hit it. It's a natural function. I think this is similar to what we saw with the S&P in the break. You've got to let the price develop a bit first. You've got to see, are we done with the highs, or are we going to make new highs? And the easiest way to watch that is if we get a move up. The highs were what, 95-ish, 21.95?
Around that, yeah.
Around that. If we get a move up there, maybe it gets to 90, maybe it even touches the high 95, but doesn't even print a buck higher, and then we see it coming off, that then starts to suggest we may have a bit of a top, because the selling at 95 the first time was real, it was strong, it's coming again the second time. On the other side, it needs to break through the support points. Now, the support points at the moment are pretty few and far between, because it's been a strong move up. This morning, I was looking at gold. Around 21.70, 75 is where we've got some intraday support. So that's a first little number to watch. And we got another minor number down in the 60s. The next number under that is around 21.40, 43, which was that spike high that we got late last year in December, which didn't count for much on the way up. But it just, on the daily chart, I just looked this morning, And the day after we broke through it, it was the low on the day after. So that's a level that you need to watch. If we break below those levels that I've just said, then maybe we got a bit of a top in play, and maybe this is going to wash out, and you've seen that overextension, and everyone's worn out by it. But if we don't, if we come down, hold those support levels, that's going to suggest that further upside is in the making, and then you need to watch those highs very carefully.
Indeed, plenty to keep an eye on. I'm also just marginally disappointed you didn't notice that I spent a long time making sure that gold was in gold on that chart. I was hoping to, win a few brownie points with that one, but never mind.
We'll move on. Gold? Is it? I thought it was yellow.
Oh, get out of it. It's gold. Oh, gold, like wolves wear. Right. We are going to go back over to Japan. There's plenty to talk about there.
Yeah, obviously, we're going to look at the dollar yen. It's the big currency to play over the BOJ. So going to have a look at the chart here. Last week, we dropped over 400 pips at one point last week. So the first thing we need to be aware of is that this event doesn't care for technical analysis. Okay, we're in one of those moments, your techs aren't going to stand up to it. This is a generational moment for Japan, and you can't count that by a fib or a moving average on a 1 hour chart. So while the tech is important in our trading, we have to know when we can rely on it and when we can't rely on it. And this is potentially one of those moments where we can't rely on it. So for me, I'd take a wider view. For me now, the 147 level is likely to be a big pivot level. If we're above it on positive wages data on Wednesday, either something yen bearish has happened elsewhere, or if it's on good news and we're holding above it, that will indicate that the market is largely well priced for the Bank of Japan. Now, if we're below, then that means there's some more room to roam on the Bank of Japan trade. Now, of course, we are playing two games in this, what's happening in Japan and what's happening in the US. So it's important to know which side we're playing at any particular moment. What we're going to find is that over Asia hours, you're going to see the yen's going to be the influence. Then as we come through Europe and into the US, the dollar side of the trade is going to take over. So you have to know which wind is blowing at any one time. But whatever happens, I'm not looking at anything, as I say, close by. I'm looking at the big price levels where something may happen. Now, to the upside, that's into the high 148, 149 big figure. On the downside, it's the 145 area. That was a big, solid area. It's been a big, solid resistance and support area going back quite some time. So it's a big level to keep an eye on. Now, at times like this, I tend to move on to those higher time frames where the levels may be a bit more reliable than they are in the lower time frames, particularly when we have this high volatility as we do now. So I think that maybe the 400, 500 pip drop is approaching the point where the market is likely to be happy where it wants to be given what's expected from the Bank of Japan, which is not starting some sort of 400 pip hike cycle. We're only looking at a potential 10 basis point hike when they do start hiking, not a hike cycle like the Fed of anyone else. So got to take that into context regarding price moves. So that's my view. I've got a bit of a wide band on this, but when we get these big volatile events, I really only want to concentrate on those, and those will be my guide for price. So what I want to ask you, Michael, is do you think at this moment we're fairly priced for the Bank of Japan, or is there maybe a bit more in the tank for the yen?
Give me the easy question again, mate. Why don't you? I would say we are probably fairly priced for the BOJ at this point. I mean, if you say we've had a 5 big figure rally essentially over the last week or 10 days. The rates market has priced a 75% chance that the BOJ are going to pull off that hike. And as we said earlier, it's probably not going to move much higher than that in terms of an implied probability. I guess the question really is, what happens if/when they do hike? Your automatic assumption, I mean, my sort of working assumption would be knee-jerk yen move higher, then becomes rumours been bought, sell the fact of a hike and the fact that it's not going to be a prolonged tightening cycle. I think if the BOJ hike and give us some sort of time frame or some sort of data conditions that they would need to see hit in order to deliver further tightening, that's when you might get a little bit more sustained yen upside. But if they deliver a hike, but otherwise keep their guidance pretty much as it was, then I think that is probably a case for a bit more downside in the yen. But and a retracement of these moves. But fundamentally, I think dollar yen, whether the BOJ give us a 10 bips hike or not, over once that is out the way, dollar yen is still just a rates trade, and it's still just a proxy for wherever treasury yields are going, in my view.
Yeah, absolutely. And we have to also look at the risk factor. Us traders, we're risk managers first and foremost. All through the last couple of years, the big price risk has been, when will the Bank of Japan turn on their policy? Now it's flipped the other way. The market's expecting them to move. So the big price risk, where you'll get the bigger reaction, is if they don't move. If the data Wednesday from the wages and Friday from Rengo don't conform, if they're coming in soft, this market's going to go haywire, and we'll probably see dollar yen up through 150 pretty quickly. So know where the big price risk. It may be a low risk, but it's still a risk you need to pay attention to.
Yeah, and we'll move on to cable in a second, but can I just say, if the BOJ don't hike, then this is going to be a lesson in how not to do central bank communication that they'll teach in universities and PR courses for years to come, you would imagine. So they've laid it on so thick over the last week or so that if they were then to just turn around and go, we'll do it in April instead, what on earth would they be playing at if they went down that route? But as you say, you certainly can't rule it out. It is by no means a zero probability that they do that. We've all been disappointed before. And I don't think there's that lower probability that we get disappointed again. Anyway, let's move on to cable. We have moved out of the recent range. Cable has spent much of the year, actually, as, well, I think at one point I christened it the most boring G10 currency out there because we were stuck between 126 or just shy of that figure and 128 for pretty much 3 months, all the way back since the 13th of December last year, which, of course, was around the time of a US CPI print and also a Fed meeting back at that point as well. But we have now seen price break to the upside of that range. And last week, price took us all the way up to just shy of that 129 figure after payrolls on Friday. That is the highest level for cable since all the way back in July of 2023. And although we couldn't take out that 129 figure, we did manage to close to the upside of that 126 to 128 range that has been in place for 3 months or so now. So that does imply that the bulls retain the upper hand, or have gained the upper hand, I should say. And in fact, Bloomberg had quite a good piece out over the weekend that I must give them credit for, because I didn't do any of this research. And that is that on a year-to-date basis, the pound is performing better against the dollar than 92% of the world's other currencies. So I won't sing Rule Britannia or God Save the King, because no one needs to hear my singing. But nonetheless, it is nice to see the pound performing well. And I think there are a few factors behind that. I think firstly is the fact that there is probably a fair bit of short covering going on. We came into the year with everyone, myself included, quite doom and gloom on the UK, quite pessimistic, and actually the economy has been performing in a surprisingly resilient way, particularly if you look at something like the composite PMI numbers. The UK composite PMI is by far and away the highest of its developed market peers. You've also got the idea that stickier inflation here in the UK will keep bank rate higher for longer than the Fed or the ECB, as Ryan touched on earlier. And now that we've had this move to the upside, that's likely to bring some new longs to the table as well. So I think while we remain above the top of that 126 to 128 range, then the balance of risks does continue to point towards further upside. And I guess it won't be too long until the bulls are cooling for us to have a look at 130 again.
Yeah, not long at all with this. We're only 150 pips away. So, yeah, it's well within shooting distance at 130 level. I'm disappointed you're not going to sing for us. Maybe I'll have to make that part of our next bet on something, whether it's NFP or whatever. We get you singing on the show. And you're positive about the UK and the pound, and I'll have to get Kyriakos to pop over and check your temperature, I think.
Well, I was going to say, don't worry, I put myself in for a checkup nonetheless, because I knew you'd be concerned about that. In fact, I was concerned about that. But yes, I am actually bullish on the pound for now, and I'm just hoping that's not a sign of a top.
Yeah, no, I hope not too, but that'd be a great indicator. I think what we're seeing in the pound is that usual volatility difference between that and euro dollar, where cable tends to move more than euro dollar does on these events. But you're right, it's a break for that 128. Buyers need to know their pain level now. Sellers need to know where they need to get back below for shorts. Can we go on for 130? Yeah, it's of course we can, but it's more going to be driven by what happens with the Fed more than the UK. Although we're getting some decent UK data this week, which are going to be could be a bit of a decider. We got the jobs numbers, whether we can believe them or not. We're getting them anyway. I'll leave that to you. I'm still on strike for getting up for 7 o'clock data, so that's all yours, mate. But yeah, and you mentioned the policy divergence as well, being a big trade, and euro sterling, that knocked down to the 85 handle yet again over the ECB. Didn't get through, found the bottom there, big number, solid down there. That was my play of the day last week. So that one's had a little bit of a bounce at the moment. As we know from that one, it can take weeks to do anything. But yeah, those little policy divergence plays that we're looking at are going to come into play. And this one, cable could have some steeper upside if we get a date from the Fed, and we're still guessing games over the Bank of England.
Yes, indeed. Won't get up for 7 a.m. UK data, but we'll get up at 3 a.m. for the Bank of Japan every month. If anyone can explain that one, then do let me know. But in the meantime, we best move on to copper.
Yeah. You got a point, but it's more interesting. I've got a better trade. I've got a better trade on the Bank of Japan than I will have on the Poxy UK jobs data that they can't even get right. So anyway, moving on before we get into that conversation. I'm going to talk about copper. If we just take the slow but rising manufacturing PMIs as an indicator, things do look like they're improving. A lot of these PMIs still in the negative territory, but they've at least found the bottom, have been ticking up, albeit slowly. And with China ending their leaders' meeting with promises of further domestic support for the economy, that includes infrastructure, there's reasons to think maybe that commodities in general might be set for a move higher if this positive news continues. Now, copper is front and centre of the commodities block. That should benefit from a pickup in manufacturing. And the recent price action suggests that maybe a break is imminent. This 393.95 level has been a very strong resistance point, but we keep coming back to it. We've also not made it back down to test the October lows when we've had recent failures at this level, which again tends to indicate that buyers are more confident in jumping on a dip. Now, I'd be watching for a break up through 395 to take us up for a test of at least the fours. But if we dip first, we got a confluence of the 55 and 200-day moving averages around 376, which is where buyers might decide to get in again. Now, if that holds, then we see a bounce. I think there's a very high possibility that we're going to go on and break that 393.95 level. But a bearish scenario would be a move below that trend line in the October 2023 lows. That would change the picture completely. So for now, I think maybe there are some green shoots coming for a rally.
Yes, indeed. I think this is, as with so many things at the moment, going to hinge on what happens in China. I think the entire commodities space hinges on that at the moment. You look at not only copper, as you're showing here, but crude. WTI stalled again at $80 a barrel and has pulled back a little bit. Iron ore had an absolute shocker of a start to the week. I think it was down 7 or 8% in Singapore. All of these commodities really need a significant pickup in demand, I would argue, to see a sustained rally. And in order to see that sustained pickup in demand, that is probably going to have to come from China. Although, as you said, we are seeing manufacturing PMIs start to find a little bit of a base elsewhere, which could be a positive at the margin. Just one thing I would say while we're talking to China more broadly, you mentioned all the meetings that were going on there last week. There was a lot of hullabaloo over, this about 5% GDP growth target. I mean, you can set whatever target you want when you just make up the data to be in line with the target anyway. So I don't quite understand why everyone is getting so overexcitable about that, but never mind. I guess people need something to talk about.
Yeah, well, it's given you something to talk about. So, you're constant moaning at Chinese manufactured data. So, it's a weekly theme, it seems. But, it is what it is. The market moves on the numbers. That's all I care about.
Indeed, it does. And I don't think I'll be getting a Christmas card from Beijing this year, it's safe to say.
Right, Beijing, before I get New Zealand, You're moving across the globe there, mate, and people you're upsetting at the moment.
Really am. Right, before I get a tap on the shoulder and get dragged off to an embassy somewhere, let's move on to our plays of the day. Right, I'm going to keep things relatively short and sweet this week and talk about the dollar. The dollar had its worst week of the year, as we touched on last week. The dollar index testing 102.5 to the downside, but just about holding that level on a closing basis on Friday. I want to be buying the dip in the dollar. I don't really see much of a convincing reason to be short the greenback at this moment in time. Really, to be frank, I want to be buying growth. And if you want to buy growth, where are you going to get that growth? It is still the US of A, with that US exceptionalism narrative still very much in play. And of course, in the much shorter term, I think there's upside risks to the inflation data that we've got this week, particularly given those shelter calculations that we touched on earlier. And I think there's also a risk of the Fed being more hawkish than market expectations, particularly in terms of those dots. So I think this is a combination for me of wanting to buy growth in the US and also seeing very little else in the G10 universe that floats my boat and looks attractive as a long at the moment. So personally, I don't think the dollar is dead just yet. Ryan, you're talking about the S&P, and if I'm being uncharitable, I think you may have nicked my idea from about 6 months ago.
Oh, dearie me. Oh, that's awful. Well, I might go on strike for that comment. I don't think I've been so insulted in all my life. Nicked yours from 6 weeks ago. Dearie me. I mean, it's not as if I've just ridden the last 200 and 350 handles buying a break at 48.10. But anyway, I'll get on to my play of the day while Michael goes and be rude to somewhere else. So you're going to get a letter from me now as well. I'm also looking at a dip buying play of the day for me, rather than a pocket picking play of the day, as Michael's calling it. S&P looks to have had another potentially overextended move. Oh dear me, look, he's gone. He's gone now.
I'm gone.
See, that's what you get. That's what you get. Right, you be quiet. Kyriakos, mute him. This is my turn now. My play of the day. Stick him on mute. So the S&P looks to have had another bit of an overextension move. This time up to near 5,200 on Friday. Since then, we've come off fairly hard, and we've got a potentially solid support zone trying to build at 5,100, 5,112. That was the former resistance area that broke, and then it's turning into support. But if that fails, I'm looking at the 50-50, 50-40 zone as a dip buying zone. Now, my chart may look like Led Zeppelin's Stairway to Heaven, but it's been a work in progress since this break of 4,800. I've had to develop these levels because, again, we haven't got any price history to rely on. So they're all these levels I've put on, taken off, added, taken away, just until the picture becomes really clear. Now, things would look more short-term bearish if we go through that 50-50, 50-40 area, and that would invalidate my long attempt here. So that's my play of the day. I'm going to go now because I'm sad.
Good stuff. Sorry, I wasn't expecting you to nibble quite as much on that one as you did. Right, exactly that. Right, before this descends into hysterics once more, we should probably wrap up the show there. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as well as he always does and controlling two slightly overgrown kids while they try and present the show. Hopefully you've enjoyed the episode this week. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets or if there's anything you'd like us to discuss. And the three of us will be back with another jam-packed show this time next week as we look ahead to, digest this week and also look ahead to what is going to be a very, very busy week next week in the financial markets. In the meantime, thanks again for watching and goodbye for now.